Number 1, as of February 2008, you are researching Jonash International, a hypothetical company subject to cyclical demand for its services. Jonash shares closed at $57.98 on February 2nd, 2007. You believe the 2003-2006 period reasonably captures average profitability. So what do we have? There's 2007. You're saying this period in here, 2003 to 2006, and we're going this way as we build up through the years. A, define normalized DPS. Well, normalized DPS is mid-cycle EPS. And this is saying that it reasonably captures average profitability. So we're saying that this appears to be a cycle. So mid-cycle EPS would be, well, we just find the average of these four. That's normalized DPS. B, calculate a normalized DPS for Jonash based on the method of historical average EPS. And then calculate the PE based on normalized DPS. Well, it's really just the sum of all the four EPS, right? So 145, 23, 213, and 55. So 145.23, add 213, add 255, and you'll divide by 4, and we'll get 159. So to calculate the PE based on that, we have 57.98. Our price is $57.98, and we add 159 as our earnings. We will get 36.465. C, calculate a normalized DPS for Jonash based on the method of average ROE and the PE based on normalized EPS. Okay, so here we're using the average ROE. So we want these bottom four here, 8.9%, 1.6, 16.3, and 21.8. So if we add them up, I'll just do it without all the decimals. 8.9 plus 1.6, 1.6 plus 16.3, and plus 21.8, and you divide that by 4, we will get, and this I'll put into decimal form, 0.1215. I know that doesn't look exactly. It should be 12.15, but these are all percents. I just want it in decimal form now. 0.1215. So if we want to find our EPS now, we will use this ROE 0.1215, and we will multiply it by our book value per share. So what is our book value per share? And notice here now we used the four historical time periods, 2003 to 2006, to find the ROE, but we're going to use the next period, or the forecasted for 2007 book value per share, and multiply by 1920, and that'll give us $2.33, and that just gives us EPS. The rest of the question then asks us to calculate what the PE ratio would be based on this. So our PE is going to be our price, 57.98, divided by the 233 that we arrived at. We get 24.88. So you have to look at the two and say which is more reasonable, to use the average historical PE or to use the average historical ROE multiplied by a current book value per share in arriving at this. And what may help sometimes is to calculate the PE, a trailing PE and a forward PE. So if we look at the PE on a trailing basis, in other words, we're going to use the $1.45 in earnings per share to calculate a trailing PE on 57.98, you'll get 39.99 on the trailing PE. But if we calculate a PE, I should put TTM down here and NTM here. If we calculate it based on the 303, the expectation of 303 on 57.98, we get a 1914. So in looking at what the forward PE would be, this seems to be a lot more comparable to what the forward PE would be. Number 2, an analyst plans to use PE and the method of comparables as a basis for recommending purchasing shares of one of two peer group companies in the business of manufacturing PDAs, personal digital assistants. Wow, these questions really date themselves, don't they? Neither company has been profitable to date, and neither is expected to have positive EPS over the next year. Data on the company's prices, trailing EPS, and expected growth rates in sales, 5-year compounded growth rates, are given in the following table. So Hand and Somersault. 22 and 10, trailing EPS is negative 220, negative 125. PE, yeah, it's not meaningful, no kidding. Expected growth, 45% and 40%. Unfortunately, because the earnings for both companies have been negative, their PEs are not meaningful. On the basis of this information, address the following. Discuss how the analyst might make a relative valuation in this case. Well, whenever we have negative EPS, we can always use an earnings yield, right? We can use earnings over price. So we can have 220 over 22 for Hand. It would be negative 2.2 over 22. And for Somersault, we'd have negative 1.25 over 10. Negative 1.25 over 10, what is this? Negative 12.5%. And this one here would give us negative 10%. And you take the company with the higher earnings yield. And the higher earnings yield is Hand. It has the higher earnings yield. Now, again, we can't really just look at the two and say, well, take the one with the higher earnings yield. Is it justified? Well, we can look at the growth rate, right? We have a 45% growth rate for Hand, 40% growth rate for Somersault. Is the higher earnings yield justified in this sense? 45% growth. So it has a higher earnings yield and it has a higher growth. I think it's fairly straightforward, right? State which stock the analyst should recommend. HAND. Most of these questions, when you read them, they tend to throw a lot of data at you, and they're quite complicated, but or they appear quite complicated. But at the heart of it, most of these questions, no matter how much data they throw at you, answers tend to be pretty simple and straightforward. If you're fighting to provide a very complicated answer, you're wrong. Most answers are typically very straightforward and very simple, no matter how complex the question is. Number 3, May Stewart, CFA, a retail analyst, is performing a PE-based comparison of two hypothetical jewelry stores as of early 2009. She has the following data for Hall-White stores and Ruffini. HS is priced at 44. RUF is priced at 22.50. HS has a simple capital structure, earned $2 per share, basic and diluted in 2008, and is expected to earn $2.20, basic and diluted in 2009. That makes the job easy. RUF has a complex capital structure as a result of its outstanding stock options. Moreover, it has several unusual items that reduced its basic EPS in 2008 to 50 cents versus the 75 that it earned in 2007. So we've got a complex capital structure, and we have unusual items in there as well. For 2009, Stewart expects RUF to achieve net income of $30 million. RUF has 30 million shares outstanding and options outstanding for additional 3,333,333 shares. A. Which PE, trailing or forward, should Stewart use to compare the two companies' valuations? Well, we have a problem. We don't have any problem with HS. HS is nice and clean, but we have a problem with RUF, is that we had some unusual items in here. So this would sort of lean us towards forward PE to begin with. And above all, valuation is on a forward-looking basis. Even relative valuation is on a forward-looking basis. I will always lean to forward. Always. In questions like this, which PE, trailing or forward, I will always circle forward unless there's a reason why I can't. I won't even debate whether I should use trailing or forward. I won't even do that. Forward. Simple. Unless I can't. That's it. Which of the two stocks is relatively more attractive when valued on the basis of PEs, assuming that all other factors are approximately the same for both sides? Well, we got a bit of a problem before we can run right into it. We have this idea of a simple capital structure versus a complex capital structure. We're going to want to compare them on diluted earnings per share. So let's go ahead and do HS on diluted earnings per share. And we're told basic and diluted is going to be 220. We know we're going to be using a forward PE, so it's our price over our earnings for our next 12 months. And the price on this one is $44. And our earnings is going to be $2.20, and we will get 20. All right, and let's look at Stewart now, RUF. RUF's price is $22.50, and we're going to, of course, use the price over earnings next 12 months, is $22.50. But now we've got to figure out what our denominator is going to be in this case, because we need diluted earnings per share. We have net income of $30 million. So let's go up here and calculate what our EPS is going to be. And that's our net income divided by the number of shares outstanding, or the weighted average number of shares outstanding. And remember, you'll recall from level 1, whenever we have shares or potential dilution from options or conversion outstanding, we assume that they were all converted as of the beginning of the year. So we'll take our 30 million that we have. We won't divide it by 30 million shares. We'll divide it by 33.3 million, on and on. Will give us 90 cents per share as opposed to $1 per share. So our fully diluted EPS is 0.90, and that will give us 25. So we had two things wrapped up in this problem. Number one is to determine whether we're going to use trailing or forward. I always say forward. Don't even think about it. It's forward unless there's something specific in the question that makes forward not an option. Then, of course, you've got to use trailing. But there should be no decision on that. The next one is, well, we had companies with different capital structures. How do we compare them? Here's what I always say. Do it on diluted, period. If it's a simple capital structure, your basic and diluted will be the same. It doesn't really matter. But always use forward, always use diluted, and these questions become easy. Oh, I don't think we answered this here. Which of the two stocks is relatively more attractive? Well, which one's more expensive? HS, we're going to pay 20 times its forward earnings. RUF, we're going to pay 25 times its forward earnings. I want to buy cheap, 20 times its forward earnings. Number 4, you are researching the valuation of the stock of a company in the food processing industry. Suppose you intend to use the mean value of the forward PEs for the food processing industry stocks as the benchmark value of the multiple. This mean PE is 18. The forward or expected EPS for the next year for the stock you are studying is $2. You calculate 18 times 2 is 36, which you take to be the intrinsic value of the stock based only on the information given here. Comparing $36 with the stock's current market price of $30, you conclude the stock is undervalued. A, give 2 reasons why your conclusion that the stock is undervalued may be an error. And we said this in the review. You can't just look at this. You have to look at where it is being relative to the industry PE. So we took an industry PE, and let's say the industry PE looked like this, but that we've always been down here or we've always been up here. So we can't just look at that. We can say one of the reasons is the stock may have a history. Bear with me here. May have a history of trailing the industry. So instead of using the 18, maybe it had a history of trailing the industry, and 15 is the appropriate multiple. Well, 15 times 2 is 30, right? So stock may have a history of trailing the industry. There's reason number 1. Reason number 2, and I'm not a big fan of this reason, but throughout the reading this was pushed to us as well, is the peer group that we've chosen. The peer group may be overvalued. So that 18 may be just too much for that particular peer group. So that if we use the 18, we'll end up with an overvalued price for a stock that's probably fairly priced, right? Peer group may be overvalued. Why do I not like this? Well, because this stock is part of the peer group. Why would the rest of the peer group be overvalued, but not this one? See, that doesn't make a lot of sense to me. So that if, let's say, I'm looking at Canadian banks and all Canadian, and I'm looking at one particular like TD, and I'm comparing it to the average PE for the industry or the peer, the other banks, Canadian banks, and it's on the high side. Why would I suddenly expect that, well, they're all overvalued, not the one that I'm looking at? Obviously, if mine is part of that group, shouldn't the whole peer group be overvalued? Wouldn't they all be bid up? So I'm not a... This here is sort of saying, well, everything else is expensive, but what I'm looking at, I don't like that. It's weak, but it's still being given to us in the reading as a reason. We'll use it, but understand that it's a weak reason, a very weak reason. B, what additional information about the stock and the peer group would support your original conclusion? Well, a history of the stock PE versus the industry, and what would support the original conclusion that it is undervalued is if this stock pretty much tracked what the average industry PE was. Then let's say, well then, okay, if we had a history of having a PE that was pretty much right at the industry average, then yeah, right now it's undervalued. Number 5, suppose an analyst uses an equity index as a comparison asset in valuing a stock. In making a decision to recommend purchase of an individual stock, which price multiple or multiples would cause concern about the impact of potential overvaluation of the equity index? So we're worried about using a multiple on the equity index if we think that there is potential overvaluation of the equity index, which price multiples would cause concern. They would all cause concern because price is the numerator. So if the equity index is overvalued and price is the numerator, they'll all be overvalued with respect to whatever fundamental value we have in the denominator. But again, as I pointed out, if we're using it to value a particular stock, and if an equity index is overvalued, whereas of I think the S&P 500, this is February 2017 that we're looking, equity index is somewhere between 23 and 2400. I would say the S&P is overvalued. If we were looking at relative valuation, though, everything's overvalued. It's not as if the one you're looking at is not subject to the same euphoria and momentum that the entire market is subject to. So I'm not a big fan of using those types of arguments of saying I'm not going to use the multiples on this particular group because the group may be overvalued. Well, if it's overvalued, so is what I'm using overvalued. What this helps me to do is not determine, let's say there's stock A. Well, yeah, then I think that's a valid argument that, well, if you're comparing it to a multiple that's overvalued, you can't tell whether A is undervalued or fairly valued. But what I can do is I can look at A and I can look at the index. And I can determine whether A is over or undervalued relative to the index, regardless if the index is overvalued. Now I have a pairs trade. So it doesn't matter if the index is overvalued. I don't care what the value on the index is. If I can identify a relative over or under evaluation, I got a pairs trade. I don't have to go with just being long A and being done with it. Yes, if I'm going to go long A, then I got to worry, well, is the index overvalued? But if I'm just setting up a pair trades, which is really what you're using relative valuation to do, is to identify elements of a pairs trade, it doesn't matter. It doesn't matter if the index is undervalued, overvalued, fairly valued. You could still identify relative valuation. Number 6, Christy Johnson, CFA, has been assigned to analyze Sandanchi. Johnson assumes that Sandanchi's earnings and dividends will grow at a constant rate of 13%. Okay, that's important information. 13%. And we're saying that earnings and dividends will grow at that rate. Exhibits 1 and 2 provide financial statements for the most recent 2 years, 7 and 8. And other information. So before we go there, let's see what we're looking for. Based on the information in Exhibits 1 and 2, and on Johnson's assumptions for Sandanchi, calculate justified trailing and forward PEs for this company. So what we need to do is remember how we calculate the justified forward and trailing PE. So we started with the formula for intrinsic value for dividends, D naught 1 plus G over R minus G. And you just divide both sides by E naught or E1, depending if you want trailing or forward. So we divide E by E naught, we'll be getting trailing earnings. So V naught divided by E naught. And of course, that'll be a justified because we're using the intrinsic value, not price now, equals D naught over E naught, 1 plus G over R minus G. And if we had divided through by E1, we would get, if you multiply D naught by 1 plus G, you'd get D1, and then you divide that by E1 over R minus G. So, before we go to the exhibit, we have clear in our head what we're looking for. We need a D naught, we need E naught. G is given to us in the problem as 13%, and we need an R. So we need 3 bits of information, and we're done. So let's go have a look at what we have. So here we are. What do we have in Exhibit 1? We have an income statement, or we have net income, we have dividends. So we have it in an aggregate amount, and we also have it broken down in earnings per share and dividends per share. This is 2007, this is 2008, so we're heading outwards as opposed to inwards. So we want this outside column. Earnings per share was 0.952. There's our E naught. Dividends per share are 0.286. There's our D naught. So we have E naught and D naught. If we look up here for net income, 60 and 18. Dividends were 18. Next year, 80 and 40. If you multiply 60 by 0.3, you'll get 18. If you multiply 80 by 0.3, you'll get 24. You could see those relationships very quickly. Which means in 2007, the dividend payout ratio was 30%. In 2008, the dividend payout ratio was 30%. And if we expect earnings and dividends to continue to grow at 13% both equally, the dividend payout ratio will continue to be 0.3. So we don't necessarily have to use the earnings per share and dividends per share, because that ratio of dividend over earnings is the dividend payout ratio. We could simply use just 0.3. Instead of looking for these two separate components, but we'll be true and honest to the formula. We've got 0.952 and 0.286. We need an R. So let's keep going and see what we have. We have a balance sheet, not a lot of information there. We have Exhibit 2, required rate of return, 14%. There's our R. Growth rate of the industry, 13. We knew that. Industry PE is 26. All right, let's go back and finish up now. So we have all of our information. All we have to do at this point is just put them in the right place. So our dividend, we said, was 0.286. Our earnings in 2008 was 0.952. And we know that if we do the division on that, we'll get 0.3. This is a dividend payout rate right here. And 1 plus G, so it's 1.13, divided by R, 0.14, minus 0.13. Tap some keys on your calculator, you'll get 33.95. Doing it here, D1 over E1, we can use the same 0.286 and 0.952. Let me show you why. This is D1. So D1 is nothing but D naught, 0.286, multiplied by 1.13. And E1 is nothing but E naught, 952, multiplied by 1.13 over 0.14 minus 0.13. The reason why we could just use the same terms is because this and this cancel out. If they have the same growth rate, we don't have to multiply them. So we'll just have the same ratio in the numerator, the same dividend payout ratio of 0.3, and divided by the 0.01 will give us 30.04. So justified trailing, 33.95, justified forward, 30.04. Another way to approach this is just to say, well, you know, I recognize that there's constant growth going forward. That's a one-stage growth model. I don't need to calculate it this way. I can calculate V naught equals D1 over R minus G, and my D1 I know is 0.286, multiplied by 1.13 over 0.14 minus 0.13 will give me a price of 32.32. 32.32. So I can find my justified PE on a trailing 12-month basis by dividing my price, 32.32, by the trailing 12 months earnings, which is 0.952, and I will get 33.95. 33.95, 33.95. I can also take the 32.32 and divide it by the forward earnings. So I can multiply 0.952, which is the trailing earnings, by 1.13, which would be E1. So just take the intrinsic value I arrive at, divided by E1. I will get 30.04. There you go. I also could have said, well, I don't really need the ratio. I could just use 0.3 and multiply by 1 plus G, or 0.3 divided by 0.01. You'll see in this, if I use the dividend payout ratio of 0.3, divided by, what do we have, 0.14 minus 0.13, which is 0.01. What do I get? 30 bucks, 30 bucks. So these can be solved in a number of different approaches. It depends on which way, when you look at the problem, which way you see your way to go. I find that if you start at this, by using this, you'll never go wrong. Even though it may be more steps than what you need, there might be a quicker way to do it. But if you just focus on saying, well, I'm going to solve them all this way, you'll get them all. All right, number 6B. Identify, within the context of the constant dividend growth model, how each of the following fundamental factors would affect the PE. The risk, or beta, increases substantially, estimated growth rate and of earnings and dividends increases, and the equity risk premium increases. All right, so it says within the context of the dividend growth model, so let's write that out. D naught 1 plus G over R minus G. And we know that R is the risk-free rate plus beta times the equity risk premium. There we go. So the first one is saying, what happens if beta increases? The risk increases substantially. Well, as beta increases, what happens to R? R increases. If R increases, what happens to V naught? V naught decreases. And what happens to P over E? If we're using V naught standing in for P, if the numerator decreases while earnings stay constant, the ratio decreases because this V naught is the numerator here in a justified PE. So as beta increases substantially, the justified PE decreases. Number 2, the estimated growth rate of earnings and dividends increases. So let's have a look at this one. As G increases, what's going to happen? The numerator here is going to increase. What's going to happen to our denominator? The denominator will decrease. What will happen to V naught? Numerator increasing, denominator decreasing, V naught will increase. And since V naught is the numerator in the PE, what will happen to the justified PE? It will increase. So this is saying that a higher growth rate can justify a higher price earnings multiple. There's nothing surprising about that statement at all. And finally, number 3, what is number 3? The equity risk premium increases. So as ERP increases, R increases, which means V naught decreases, which means, because this becomes the numerator here, if the numerator is increasing, this then is decreasing. So as the equity risk premium increases, as equities are perceived to be riskier for the same level of earnings, the multiple that you're willing to pay for an equity will decrease. That, I think, makes sense as well. Tom Smithfield is valuing the stock of a food processing business. He feels confident explicitly projecting earnings and dividends to 3 years. Other information and estimates are as follows. Required rate of return, 0.09, so that is my R. Average dividend payout rate for mature companies in the market, 0.45. To put that in a way that we're familiar, that's D naught over E naught, 0.45. Industry average ROE, 10%. E3, $3. That's earnings in year 3, $3. Industry average PE is 12. On the basis of this information, answer the following questions. Compute terminal value V3 based on comparables. Well, I think we can do that rather easily. We have $3 in earnings. We have a PE of 12. 3 times 12 is 36. That was straightforward. Contrast your answer in part A to an estimate of terminal value based on the Gordon growth model. So, what are we going to need here? Well, we're asked to find V3. We know that is D4 over R minus G. So now we have to go looking. Do we have a D4? We do not have a D4. We don't even have a D3. But we do have E3 and a dividend payout ratio. So we know that D4 is going to be D3, which is E3 times the dividend payout ratio, which is $3 times 0.45. There is D4. We must multiply it by 1 plus a growth rate. Do we have a growth rate? We do not have a growth rate, so we have to find a growth rate. We know that G is equal to ROE times the retention rate. We have ROE at 10%, 0.10. Do we have a retention rate? No, but we have a dividend payout rate. So if the dividend payout rate is 0.45, the retention rate must be 0.55, which will give us 0.055. Now we have a G. Multiply this by 1.055, and then it is our R, 0.09 minus 0.055, and that will give us 4069. So using the Gordon growth model, we get to 4069. Using comparables, we get to 36. So now it would just be a matter of, well, okay, are we justified in having a higher price? So we would look at the industry average PE and look at, well, what's the average growth rate in the industry? And determine whether or not our growth rate seems to be higher than that. But these are fairly close. They're within 10%, 40.69 minus 10%, we get to 36. There we go. Number 8, discuss 3 types of stocks or investment situations for which an analyst could appropriately use price to book in valuation. And we talked about 3 of them. The first one was whether the company was going to continue on as a going concern. And if it's not, if it's a liquidation or a wind-up, then we would use price to book in that situation. Another situation we would use price to book is if the majority of the firm's assets are in liquid assets or financial assets. So mostly liquid. So we can think of banks or financials. I'll just put financials in here as an example. And finally, the third instance, there it is, EPS less than 0, or EPS equal to 0, or in a situation where EPS just wasn't a valid metric to use. Number 9, Aradatech is a multinational distributor of semiconductor chips and related products to businesses. Its leading competitor around the world is Trime Electronics. Aradatech has a current market price of $10, 20 million shares outstanding, and annual sales of $1 billion, 5% profit margin. So we're given 4 bits of information on Aradatech. We're given price, number of shares, sales, and a profit margin. Trime has a market price of $20, 30 million shares outstanding, annual sales of $1.6 billion, profit margin of 4.9. So for the 2 companies, we're given the same bits of information. Based on the information given, answer the following questions. Which of the 2 companies has a more attractive valuation based on price to sales? So that's easy enough. It's telling us what our numerator should be and what our denominator should be. So let's go ahead and look at AR. And there are 2 ways that we can approach this. It's looking for price to sales. So we can take the price, $10, and then we can take our sales of $1 billion and divide it by the $200 million. We can go that way. Or we can take our price of $10, multiply it by 20 million shares. We'll get $200 million. And divided by the full amount of sales, 1 billion, and we'll get 0.2. You'll arrive at 0.2 whether you use your numerator and denominator both on a per share basis, or whether you use your numerator and denominator in an aggregate basis, you'll get to the same number. So for TR, let's do the same thing. We have $20 a share, 30 million shares. 20 times 30 is 600. So we'll have 600 million over 1.6 billion. And that will give us 0.375. And the lower the number, the better, because that means you're paying less, right? So how many times sales do you want to pay? 0.2 times sales or 0.375? I'd rather pay the lowest amount, so our winner here is Aradatech. Identify and explain one advantage of price to sales over price to earnings as a valuation tool. Well, we know sales always is greater than 0. Always greater than 0. So we'll put always greater than 0. That should be a greater than sign. Let me fix that. Greater than 0. Another reason is earnings is a highly managed number. So that sales is less open to manipulation. We're not going to say it's not a manipulable number. It's less open to manipulation. Number 10, Wilhelm Müller, CFA, has organized the selected data on 4 food companies that appear below. TTM stands for trailing 12 months. I think we should know that, right? What do we have? We have 4 different companies, but more importantly, we have stock price, shares outstanding, market cap, enterprise value, sales, operating income, operating profit margin, net income, There's our trailing 12 months EPS, our return on equity, net profit margin. So we got a lot on 4 different companies. On the basis of the data given, answer the following questions. Calculate the trailing PE and enterprise value to sales for each company. So let's make sure we have the appropriate information. We have a price on all of them. There's the first thing that we have. Well, we need 4 items. There's one of the 4. Calculate the trailing PE. Do we have trailing, there's our EPS, trailing 12 months. So there's the second one. So that's going to be easy enough. There's the first item we need. Here's the second item we need. We just have to do the division all the way through, now that we've identified the variables we need. Enterprise value to sales. Do we have an enterprise value? We certainly do, all the way across. So we have that variable. And do we have sales? Sales in millions. There we go. Our enterprise value is in millions, so we don't have to worry about the decimals being off. The rest is straightforward. So we've got those 4 items. All we have to do is do the calculator work. B says, explain on the basis of fundamentals why these stocks have different enterprise value to sales multiples. So we are obviously going to find that they're different. And the question is, can you explain why they're different? So let's go ahead and solve these. Well, since all we have left is calculator work, I didn't want to make you sit through me writing it out on the screen. The hardest part is figuring out, well, what formulas are we using? We were told which ones to use, and then of finding the relevant variables we need. Once we have that, it's plug and play, right? So all we have to do for the PE is take the price, $25.70, and divide it by the trailing earnings of $1.30. Here it is right here, $25.70 over $1.30, and I've done the same thing for the other 4. And here is our PE, the trailing 12 months PE, 19.7, 29.4, 20.7, 10.1, a wide range on PE. If we step up to the level of the firm, can we tighten up that range is sort of, I think, where we're leaning. Enterprise value to sales. Well, here's our enterprise value across this row for all 4. Sales are right below it across here, so it's just a matter of putting in the numbers, doing the division, 0.91, 0.37, 0.22, and 0.67. And then the question said, yeah, of these differences, are they justified? Well, we sort of have to ask the question, well, what adds to enterprise value? Economic profit being greater than our required rate of return. So we're gonna look at our profitability to determine if differences in profitability can explain this. But here's the bit of the not so much of a trick, but where you have to pay attention. We're given 2 profit measures. We're giving operating income and we're giving net income. If we're looking at enterprise value, that is the value attributable to all providers of capital. Net income is the income available to preferred and common holders, only to equity. So we don't want to look at differences in net income. We want to look at differences in an income that is comparable to enterprise value. Income available to all providers of capital. So we're going to look at operating income, and we're given the operating profit margins, 691, 126, 107, and 623. So we just have to ask, are these enterprise values justified? Well, what's our highest operating profit margin? 691. What's our highest enterprise value to sales? 0.916. What is our lowest? 1.07. What is our lowest here? 0.221. And in fact, going from 107 to 126, it increases. And of course, going from 691 down to 623, it decreases. So it looks like a lot of the difference in enterprise value to sales can be explained by the difference in operating profit. So that we cannot automatically say, well, Drisket at 221 and Hopelli Foods at 916. If we look at the discrepancy there, perhaps we think that one is really undervalued compared to another. Not when we see that the 0.221, which is fairly inexpensive, but it has a very small operating profit margin. It's justified, and the higher value for enterprise value to sales for Hopelli appears to be justified by its operating margin. So the difference in the two, or the difference across all 4, does not necessarily mean that we've identified any mispricing. These differences appear to be justified by the differences in their operating profit margin. All right, number 11, John Jones, CFA, is head of the research department at Peninsula Research. Peninsular has a client who has inquired about the valuation method best suited for comparing companies in an industry with the following characteristics. Principal competitors within the industry are located in the United States, France, Japan, and Brazil. So I have multi-country issue to consider here. The industry is currently operating at a cyclical low with many companies reporting losses. So I have negative earnings that I have to deal with here. Jones recommends that the client consider the following valuation ratios: PE, price to book, and enterprise value to sales. Determine which one of the three valuation ratios is most appropriate for comparing companies in this industry. Support your answer with one reason that makes that ratio superior to either of the other two ratios in the case. Well, let's start with the first one, price to earnings. We can eliminate that one right away. So let's eliminate that one. And why are we eliminating that one? Because of this point over here that earnings are less than zero in some cases. There we go. So there's a good reason why we want to eliminate that. Price to book. What do we want to do with that? Well, we're going to eliminate that one as well. Number one, these are going concerns. These are going concerns, so price to book probably doesn't appear appropriate. But we're not told what industry it is. Maybe the price to book ratio is the appropriate ratio to use in that particular industry. But we have to consider that they're in a bunch of different locations with a bunch of different accounting reporting standards for how they would report their assets. So we have multi-country issues here. They're not all in the same issue. So multi-country comparisons are going to be difficult. Comparisons, difficult with book. So if we have eliminated A and B, it's asking us which one of the three we must be choosing enterprise value to sales. Enterprise value is a market-determined number. It's the market value of equity plus the market value of debt. And if it has a simple capital structure, that's as far as we need to go. It's market determined, first of all. Secondly, the denominator sales are less open to manipulation. And I think that will answer our question. We've given a justification for the numerator and the denominator. And I shouldn't just say manipulation. I don't like just saying manipulation, but also management. You have earnings management. That's not so much manipulation, but it's what management does to reflect the better picture for the business. Manipulation almost sounds nefarious in that sense. Management, sounds a little bit more honest. I guess we can use the word. There we go. Number 11. Number 12. Giantin Growing AG is currently selling for $38.50. Trailing 12-month EPS and dividend per share of $136 and $91 respectively. Company's PE is 28.3, price to book is 7.1, price to sales is 2.9. The ROE is 27% and the profit margin on sales is 10.24%. Treasury bond rate is 4.9, equity risk premium 5.5, and GG's beta is 1.2. Now, when you get these kind of questions that throw a whole bunch of data at you, it can be overwhelming. Because you're getting all this information, you're saying, oh, it's starting to look really confusing. Just let it go. Let it go. Look at the question that's being asked and say, what information do I need? And I have a whole pool of information. So let's have a look. What is GG's required rate of return based on the capital asset pricing model? Well, what do we know about CAPM? It is the risk-free rate plus beta times an equity risk premium. I need 3 bits of information. Let me go hunting. I'm given a treasury bond rate of 4.9, 0.049. Do I have a beta? Beta is 1.2. Do I have an equity risk premium? 5.5, 0.055. There we go. What am I going to get? 0.115. So don't get overwhelmed when you look at, especially in these vignettes that start throwing all these exhibits at you. That can be really overwhelming. Get a feel for what information is being provided to you without beginning to analyze it right away. You just want to get an inventory of what you have. And then read the question. Determine what your roadmap looks like, which is your formula. Once you have your formula, say, great, I'm not going to let all this bother me. I'm looking for 3 things and 3 things only right here and now, and that's it. There I go. What have I got now? Now I've got another bit of information. I've got my R. Let's look at the rest of this question. Okay, B. before I start, all I've done here is I've just repeated the stuff that was on the last page. All the little bits of information I've just repeated, and I put the R down here that we calculated. So let's go. Assume that the dividend and earnings growth rates are 9%. So what are we given here? We're given our G all of a sudden. Okay, so there's 9%. What trailing PE, PP, and PS multiples would be justified in light of the required rate of return in Part A and current values of the dividend payout ratio, ROE, and profit margin? So that may sound confusing, right? But let's break it down. What are we being asked? It's saying what trailing multiples would be justified. Okay, so we need trailing multiples. So we need price to earnings. We need price, and since it's trailing, right, it's all P, E naught, B naught, and S naught, right? There's what we need. It's asking us what trailing multiples would be justified in light of the required rate of return in Part A and current values of the dividend payout ratio. Well, what's a dividend payout ratio? It's dividends over earnings per share. So what is this? This will be 0.91 over 1.36. This will be 0.669. Okay, so in light of the current values of the dividend payout ratio, ROE, we given an ROE, yes we are, and profit margin, and we're given a profit margin. So it's saying what multiples would be justified. So before we start, let's just trust our formulas. What is P naught over E naught? We know it is D naught over E naught. Well, we just did that, D naught over E naught, right? That's D naught over E naught. What is that? That's the dividend payout ratio. So let's just call it 1 minus RR. 1 plus G over R minus G. Now, why am I calling it 1 minus RR? When we derived the formula, that was one of the steps we got to along the way, 1 minus RR. I'd rather just call it DPR. You can call it DPR, or you can call it 1 minus RR. The reason we're going to put 1 minus RR will become clear when we get down to price to sales. What was price to book? In fact, all of these, we know all of these. R minus G. We just have to worry about our numerators now, right? Price to book, remember, was ROE minus G. And this one was our net profit margin, 1 minus RR, 1 plus G. And we kept the 1 minus RR because in the derivation, how we derived it, we ended up with 1 minus RR. Again, I don't really care about the 1 minus RR. I'd rather just take it out and write dividend payout ratio altogether. Dividend payout ratio, because if I have the I can do better than that, come on now, the dividend payout ratio, because if I have to calculate the dividend payout ratio as 0.69 and then calculate RR and then recalculate 1 minus RR to get back to 0.669, doesn't make a lot of sense to me. So go ahead and put the dividend payout ratio in. I put 1 minus RR just so that it's recognizable with the derivation we did in the chapter. But after you understand what it means, just take it out. So let's go ahead and see if we can calculate what we have at this point. At this point, basically at this point, I would say we have basically solved the problem at this point, because we have our formulas. We have all of the bits of information we need. The rest is calculator work. What's our dividend payout ratio? 0.669. What's our growth rate? 1.09. What is our R? 0.115 minus our G, 0.09. In fact, all of our denominators are identical. All of our denominators will be identical. What's our ROE? Is 0.27 minus our G, 0.09. What's our net profit margin? 0.1024, which is here. What is our dividend payout ratio? 0.669. And what is our G? 1.09. And the rest is just calculator work. You'll get to 29.17 here. We'll get to 7.2 here, and we'll get to 2.99 here. And let's have a look. Let's just compare them. We got 29.17 on a justified PE versus 28.3. It's currently selling at 28.3. It can justify 29.17, so it could trade at a little higher multiple. We've got a justified 7.2 versus a 7.1, so it could trade up a little bit. And we got 2.99 versus a 2.9, so it could trade up a little bit. Overall, these are almost the same. If we had to give some idea of where we're either fairly valued or slightly, and I mean slightly undervalued. These are justified. These are actual. The actuals are lower than the justifieds, so that they could actually trade up to these justified levels. Given the assumptions, given that the assumptions in constant growth model are appropriate, state and justify whether GG based on fundamentals appears to be fairly valued, overvalued, or undervalued. Well, we just did that. It appears to be slightly undervalued. So again, just as a wrap up here, the questions, especially the vignettes in equity, will throw you a lot of exhibits, a lot of data. A lot of it you're not going to need. Don't get overwhelmed with it. Read the question. Understand your big job here is, what am I being asked for? Once you know what you're being asked for, write it down and say, there I go. This is all I need to find. Once I solve for this, that's it. I've got it. I just have to make sure I finish by answering the question. And the last question says, make an opinion. What do you think? And of course, you have to then look at them and make some kind of judgment on it. Jorge Zaldiz, CFA, is researching the relative valuation of two companies in the aerospace defense industry, NCI Heavy Industries and Relay Group International. So here's NCI, here's RGI, here's some information, some data points on both of those companies. It has gathered the relevant information on the companies in the following table. What do we have? We have their prices, shares outstanding, market value of debt, book value of debt, cash and investments, net income from continuing operations, interest, depreciation, taxes. Okay. Use the information in the table and answer the following questions. Calculate price to EBITDA for NCI and RGI. So do we have price? Let's look for our variables. Do we have price? We have price. It's given. Do we have EBITDA? EBITDA is not given, so we're going to have to arrive at EBITDA. So let's have a look at what we have to get there. There's our T for taxes. There's D&A. There's depreciation, amortization. There's interest. There's ITA. We just need EB. We have net income and net income from continuing operations. Well, now for RGI, it doesn't matter. For NCI, we have two different numbers. Which one are you more likely to use? In this case, you're going to want to use continuing operations, right? You're going to want to take out those non-recurring events. So clearly there's some recurring event going on in here that's boosting net income. That's not going to repeat, so we're going to just take it out and we're going to use the 8. So let's go ahead and calculate these for both RGI and for NCI. So let's calculate our EBITDA first. For RGI, it's going to be our net income from continuing operations, 49.5. To that, we will add back our interest expense, our depreciation and amortization, and our taxes, and we will get 62.50. And per share, we're going to need a per share basis now. We'll take the 62.5 and divided by how many shares outstanding do we have? 5 million. What is our 62.5? Is it in millions as well? It's not telling us, but I imagine these are all millions, so we just have to divide it by 5. We'll get 12.50. So our price to EBITDA, because our price is per share, is 150 divided by the 12.50 gives us 12x times. Let's do it for NCI now. NCI's EBITDA is, we're going to start with the 8, we're going to add the 5, the 4, and the 3, and that'll give us 20. And then we need it per share, so we'll take the 20 and divide by, how many shares do we have here? We have 2 million, which is 10. So our price to EBITDA, in this case, what's our price? Is 100 divided by the 10 equals 10 times. So RGI is selling for 12 times its EBITDA. NCI is selling for only 10 times its EBITDA. Remember, we want to buy stuff as cheaply as possible, right? So how many times EBITDA do you want to pay? 10 times, or would you rather pay 12 times EBITDA? I'd rather pay 10 times EBITDA. So far, just based on this, based on a price to EBITDA, we would say NCI seems to be the more inexpensive one. But let's see what else we have to do. Calculate enterprise value to EBITDA for NCI and RGI. So let's go ahead and do that. We need an enterprise value for this, and to do that, we are going to need the Let's see. Let's start with RGI. It is the market value of equity. We're not given the market value of equity, but we're given a price per share and the number of shares outstanding. So we have 150 times 5, and that'll be in millions, plus market value of debt is 50. Anything else we need here? We have cash and cash investments. We can take that out because we can pay ourselves back. We get $7.95 on RGI. What about NCI now? NCI is $100 at 2 million, so that'll be 100 times 2, plus market value of debt is 100. Any cash? Yeah, we can pay ourselves back too. We get $298. So there's our enterprise value. So now we can calculate enterprise value to EBITDA, EV to EBITDA, DA, and we'll start with RGI. How's that? What is RGI going to sit at? RGI is $7.95. $7.952. What was our EBITDA? $62.50. And we get 1212.72. And let's calculate it for NCI at this point, and we have 298 over, what did we have here? We had 20. 298 over 20 gives us 14.90. So we're getting a bit of a different story here. Enterprise value to EBITDA here is only 12.72. For NGI, it's 14.9. It's much higher. All right. C. Which company should Zaldis recommend as relatively undervalued and justify the selection? All right. Well, let's look at the price to EBITDA multiples for now. We know that they're different, but are they justified? Are they justified being different? Well, let's have a look at see if we can't come up with any information here. Our net income 49.5 is much greater than the net income for NCI. Our interest expense is lower, which is leading to the conclusion that we probably have less debt, and we appear to be more tax efficient. RGI appears to be more tax efficient. So perhaps the difference between the two is justified. When we move over to enterprise value to EBITDA, remember, enterprise value is a nice clean number. That's what the market, it's a market determined number. So if we look at the valuation here, it appears that RGI appears to be the undervalued one. RGI. There we go. All right, 14. Define the major alternative cash flow concepts and state one limitation of each. So we know if we're looking at just CF, if we say that we're looking at price to CF, this is the definition for CF. Earnings per share plus depreciation, amortization, or depletion per share. This ignores fixed capital investment, working capital investment, and any after-tax interest impact on cash flows. The second definition was just straight old cash flow from operations. This ignores fixed capital investment. Next was free cash flow to equity. The limitation we said with that is that it's much more volatile than the other measures, and it can come in as less than zero. And then we said that EBITDA was another proxy for cash flow. This ignores both working capital investment and fixed capital investment. 15. Data for two hypothetical companies in the pharmaceutical industry, DriveMed and MAT Technology, are given in the following table. For both companies, expenditures on fixed capital and working capital, so this is fixed capital, INV, and working capital investment during the previous year reflect anticipated average expenditures over the foreseeable horizon. What do we have? Current price for both. Trailing cash flow per share, that is the first definition up here, 360 and 6. Price to cash flow, 12.8 and 13. They look roughly equal on that measure. Trailing free cash flow to equity per share, that takes into consideration the cash required for reinvestment, 1 versus 5. The price to free cash flow to equity, 46 times versus 15 times. Advantage MAT on this one. Consensus 5-year growth forecast, 15% versus 20%. Advantage MAT on this one. And they both have identical betas, identical risk. So MAT has a higher G. It has a lower price per free cash flow to equity. even though they're comparable on price to cash flow. It's we were being told here that these expenditures that we experienced over the last year are expected to continue over the foreseeable horizon. You have to include that in to the price to cash flow, because that's the cash flow available to shareholders, right? So what are we being asked? On the basis of the information supplied, discuss the valuation of MAT Technology relative to DriveMed. Justify your conclusion. I think we just did that. Advantage MAT on both price to free cash flow to equity and on the growth rate. MAT appears to be undervalued relative to DriveMed. Another way of saying it is DriveMed appears to be overvalued relative to MAT. 16, your value-oriented investment management firm. Okay, well, it's taking some pains to put some adjectives here. Let me underline that. Value-oriented investment firm recently hired a new analyst, Bob Westward, because of his expertise in the life sciences and biotechnology areas. At the firm's weekly meeting, during which each analyst proposes a stock idea for inclusion in the firm's approved list, Westward recommends High Tech Clothing International. He bases his recommendation on two considerations. First, HCI has pending patent applications, but a PE that he judges to be low in light of the potential earnings from the patented products. Okay, is that in line with value orientation? Yeah, okay. Second, HCI has had high relative strength versus the S&P 500 over the past month. High relative strength, is that in line with value-oriented investment? Not really. No, this is a more momentum. That's a momentum indicator. Explain the difference between Westward's two approaches, that is, the use of price multiples and the relative strength approach. Well, it's very simple. It is a fundamental approach versus a technical approach. State which, if any, of the basis for Westward's recommendation is consistent with the investment orientation of the firm. Well, we answered that just in the question itself. Only the PE is consistent with being a value-oriented firm. The technical indicator, this is a momentum indicator. It may have merit on its own. I don't know. You know me in technical analysis. I'm not a big fan of it. But if the technicals support what the fundamentals are saying, then yeah, I can live with it. But if you're making decisions just purely on technical basis and no fundamental support at all, I can't live with that. But in this case, only the PE is consistent with exactly what's going on here, value-oriented investment management, right? Number 17, Kirsten Cruz, a portfolio manager, has an important client who wants to alter the composition of her equity portfolio, which is currently a diversified portfolio. All right, diversified portfolio of 60 global common stocks. Because of concerns about the economy and based on the thesis that the consumer staples sector will be less hurt than others in a recession, the client wants to add a group of stocks from the consumer staples sector. In addition, the client wants stocks that meet the following criteria. Stocks must be considered large cap, have a large market capitalization. Nothing wrong with that. Stocks must have a dividend yield of at least 4%. Okay, but there is a problem with this, I think you can see. Let's say that a company, a large cap company, has declining fortunes, but their dividend hasn't been cut yet. What you'll get are, when you include stocks that have a dividend yield of more than 4%, is you'll get a lot of stocks in there that will also be at risk of a dividend cut. So you might want to say of at least 4%, but no greater than, let's say, 7.4%, or whatever cutoff you feel that beyond which, for a large cap stock, might represent a red flag. Stocks must have a forward PE of no greater than 15. We can see that we have a value investor here. What's the problem with the PE? No greater than 15. That also includes PEs that are negative. And if you have a negative PE, you have negative earnings. Negative earnings, even if you have a dividend over 4%, what I just set up here, you have a dividend over 4%, you have negative earnings, you got a big red flag, you got a potential dividend cut coming in. You don't want to have to sift through those. So if you're going to do a stock screener, it's because you don't want to sit through all that stuff. Well, it doesn't take much to put in a minimum PE. Stocks must have a PE no greater than 15. And what do we know about consumer staples? Well, maybe they trade at least 8, 9, 10 times earnings. Anything below that you might not want to consider. So you might want to put a minimum in there as well. Same with the dividend yield. You might want to put a maximum in there. The table shows how many stocks satisfy each screen, which was run in July 2008. Consumer staples, 277. Large cap, greater than 9.7 million, 446. So we're only interested in the consumer staples sector, so we'd want the, if there are 277 here, let me get a better color, 277 here and 446 here. This is all we're interested in, is this intersection. Dividend yield of at least 4%. Again, it may be that. We're interested in only this little intersection over here now. And finally, PE less than 15, quite a few of them, right? So we're really interested in all of the ands for this. What do we get? 6 out of that screen. Had we been a little bit more specific and maybe picked a maximum or a minimum PE, that might have dropped a bit more. We don't know, but it might have. So continuing on with 17, I've reproduced the screener up top here. The stocks meeting all 4 screens were Altria Group, British American Tobacco, Reynolds American, Tesco PLC, Unilever, and another Unilever. So two of the same companies. They're ADRs as well. Altria cigarette company, British American Tobacco cigarette company, Reynolds American cigarette company. Remember, our client here had a well-diversified portfolio of 60 global stocks and is looking to add consumer staples. And while tobacco is considered a consumer staple, it's focusing, this screener pretty much just picked out all of those. Critique the construction of the screen. I think we did by having an uncapped dividend yield. We also include stocks with dividend yields that just simply would be too high to be justified based on the price supporting that dividend. And we critique the PE less than 15, could also include negative PEs as well. Not only that, you may get a PE of, let's say, a company of 4 or 5, a PE of 4 or 5, simply because nobody wants to pay more than 4 or 5 times earnings for a particular type of company because of the risk involved. These are tobacco companies. They're open to lawsuits all the time. So you certainly don't want to pay a high multiple of earnings for companies like that. So when you get deep value, companies selling 3, 4, 5 times earnings, there's typically some added risk going with it that justifies the reason why they're only selling at 3, 4, 5 times, which is why I said if you're looking at less than 15, you may decide that, anything less than 8 times earnings represents a risk category I'm not interested in. Companies that have very low growth or flat growth or declining growth will trade at lower and lower PEs. So I think we can find a lot wrong with the screen in choosing a minimum dividend yield unbounded and a maximum PE unbounded to the bottom. Do these criteria identify appropriate additions to the client's portfolio? Well, maybe one. If you're going to add tobacco, add one, but to add 3 of them, and here you have, this is the same company, parent and subsidiary, I think. I'm not really sure on the NV and the PLC, but I believe these are the same company in some respect. So not really. These, you might have found one in here, you might have said, well, okay, maybe Altria, we'll add Altria, or British American Tobacco, or Reynolds, one of them, but you certainly wouldn't add all 3. Or keep going with that, all 6. Okay, questions 18 to 24 relate to Mark Cannon. Mark Cannon is updating research reports on 2 well-established consumer companies before first quarter 2011 earnings reports are released. His supervisor, Sherilyn Ritter, has asked Cannon to use market-based valuations when updating the reports. Delight Beverage is a manufacturer and distributor of soft drinks and recently acquired a major water bottling company in order to offer a broader product line. So that's important. They recently acquired a major water bottling company. So on a going forward basis, they have an acquisition that they need to digest. The acquisition will have a significant impact on Delight's future results. So if you were going to value this, would you value it on a trailing or a forward multiple? Clearly, their fortunes have changed. You certainly wouldn't use the trailing multiple, no longer makes sense at this point, right? If it says here the acquisition will have a significant impact on Delight's future results, it's basically telling you the past is not going to be representative of the future. You're going to be looking at the future here. YouFixit is a United States retail distributor of products for home improvement, primarily for those consumers who choose to do the work themselves. Well, that makes sense, right, with a name like YouFixit? The home improvement industry is cyclical. The industry was adversely affected by the recent downturn in the economy, the level of foreclosures, and slow home sales. Although sales and earnings at YouFixit weakened, same-store sales are beginning to improve as consumers undertake more home improvement projects. Poor-performing stores were closed, resulting in significant restructuring charges in 2010. So again, we have significant restructuring charges in the past. Would that be indicative of the future? Probably not. So again, with YouFixit, we're sort of getting some information here that the past is not really relevant for the future, but for different reasons. Here we have a probably one-time restructuring charge in the past we won't expect in the future. For Delight Beverages, we have an acquisition on a going-forward basis that's not reflected in past earnings. Before approving Cannon's work, Cannon, however you want to say it, Ritter wants to discuss the calculations and choices of ratios used in the valuation of Delight and YouFixit. The data used by Cannon and his analysis is summarized in Exhibit 1. So here's Delight, here's YouFixit, 2010 earnings per share, 2011 estimated EPS. We have book value per share, current share price, sales in billions, free cash flow per share, and shares outstanding. Let's scroll up here so we have more room on the screen. Cannon advises Ritter that he is considering 3 different approaches to value the shares of YouFixit. Approach number 1, price to book. So in our mind, we should start thinking, is that appropriate, a price to book? You have a beverage company and you have a home improvement company. Neither one of them sound like financial companies or insurance companies or companies that have the majority of their assets in liquid financial assets. So right away I'm thinking, I don't really know. They're both going concerns, so I don't really know. I'd tend to discount price to book and say, I don't think that's appropriate. In my mind, I'm thinking this. I don't know what the question is. I'm just, as I look at price to book in the scenario I have, I'm already saying I'm not a fan of approach number 1. Number 2, price to earnings ratio using trailing earnings. Well, we've already pretty much eliminated price to earnings in just the narration that we went through. As we were reading, we were seeing, hey, look, the narration is telling us that the past is nothing like the future. And approach 3, price to earnings ratio using normalized earnings. Well, that one you'd think about and go, well, I'm still looking at the past in terms of normalized earnings here. Cannon tells Ritter that he calculated the price to sales ratio for YouFixit, but chose not to use it in the valuation of the shares. Cannon states to Ritter that it is more appropriate to use the price to earnings ratio than the price to sales ratio because earnings are more stable than sales. Reason number 1 is not true. Earnings are less easily manipulated than sales. Reason number 2 is not true. The PE ratio reflects financial leverage, whereas the price to sales ratio does not. Well, that is true. Okay, so we can say, okay, well, reason 3 is a valid reason, but 1 and 2 certainly aren't. Let's continue on here. Cannon also informs Ritter that he did not use the price to cash flow multiple in valuing the shares of Delight or YouFixit. The reason is that he could not identify a cash flow measure that would both account for working capital and non-cash revenues and also be after interest expense and thus not be mismatched with share price. Ritter advises Cannon that such a cash flow measure does exist. As you were reading this, you were saying, wait a minute, there is such a measure. Ritter provides Cannon with financial data on 3 close competitors, as well as the overall beverage sector, which includes other competitors in Exhibit 2. And Exhibit 2 is down here. She asks Cannon to determine, based on the price-earnings growth, the PEG ratio, which Delight shares whether Delight shares are overvalued, fairly valued, or undervalued. So here's Delight. We don't have a forward PE. There's our earnings growth. And we have the forward PE on 4 other beverage companies, and we have their growth. 16.6 roughly, 15.6, 44.1, and 16.4. Tasty Root Beer seems way out of line at 44, but if we look at growth, 12, 9, 11, 20% growth, 18. It might be justified. I don't know about jumping from 16 to 44, but I see that growth might be supporting it. Let me continue reading. After providing Ritter his answer, Cannon is concerned about the inclusion of Tasty Root Beer. Well, there we go. Our eyes should have been drawn to it anyways, right? The inclusion of tasty root beer in the comparables analysis. Specifically, Kanan asks Ritter, I feel we should mitigate the effect of large outliers, but not the impact of small outliers, those close to zero, when calculating the beverage sector PE. What measure of central tendency would you suggest we use to address this concern? Well, what measure of central tendency did we use that mitigated the effect of large outliers but did not eliminate the effect of small ones? That was the harmonic mean, right? So we almost have an answer for this one. We don't even know if it's a question. We're just reading. All right. Ritter requests that Kanan incorporate their discussion points before submitting the reports for final approval. Let's go to the questions now. So 18. Based on the information in Exhibit 1, the most appropriate price-to-earnings ratio to use in the valuation of Delight is closest to. Well, we know we're going to use a forward PE. So if we're going to use a forward PE, price over E1, we're going to need price and we're going to need our estimated EPS going forward. So let's just jump back to our exhibit and let's see what we have here. All right, if we scroll up here, let's find our price. And do we have a price somewhere? Current share price, $65.50 for Delight Beverages, and 2001 estimated EPS of $3.50. So we're going to use a forward PE, and we're going to use $65.50 divided by $3.50. So we'll get $65.50 divided by $3.50, and that will give us 18.714. Do we see that somewhere? There we go, 18.71. 19, based upon the information in Exhibit 1, the price-to-sales ratio for YouFixit. Let me make sure we're looking at the right one. YouFixit is closest to. Now, you got to be careful about this. In this first question, our eyes were drawn to Delight. We looked at Delight. We calculated Delight. In the second one, it jumps over to YouFixit. So when we go looking for that data, we got to make sure we're in the right column, because I guarantee you one of these answers will be the price-to-sales ratio for Delight. We'll calculate it, we'll see it, and we'll circle it saying, there we go. Meanwhile, we need YouFixit. So let's make sure we know what we're doing here. We're looking for the price-to-sales ratio of YouFixit. So what's the price? Not $65.50. $65.50 is Delight. So let's not rush and put down the $65.50. So let's go have a look at that and see what we find. So here we are with we need price-to-sales. So what is our price for YouFixit? Make sure you're in the right column now. The current share price is $37.23, and our sales in billions are $67.44, but that's in billions. This is an aggregate amount. This is a per share amount. We're going to need the shares outstanding at the end of the year. Now, we can either multiply the current share price by the number of shares and then divide by 67.4 billion, or divide 67.44 billion by the number of shares outstanding, and then divide the current share price by that number. So we can take two approaches, but we know that we have to get one of them. We only have to get it into a per share number. So let's go take care of that. Okay, so our price to sales in this respect, we had, what was our sales? It was 67.44 billion, and we want to divide that by the number of shares, and the shares we want in billions as well. So let's put the decimal place in the right place. 1.6388, I believe, 21 will do it. So that'll get it into, this is our sales per share, and we need our numerator, and our price was $37.23. So just make sure that you get that that you're not dividing by two different numbers. Now, we easily could have arrived at the same thing by taking the number of shares and multiplying the price by it and getting an aggregate price divided by aggregate sales. Either way, we'll get the same thing, 0.9047. Do we have a 0.90? We have a 0.90. 20. Which valuation approach would be most appropriate in valuing shares of YouFixit? Let's go back and look at those approaches again, and let's see if we can eliminate them based on what we see. I think we've already eliminated them, but let's just do it again, all right? Which one would be most appropriate? So let's look at our approaches. Price to book. Remember now, YouFixit over here is the home improvement retail stores. Clearly, the majority of their assets aren't going to be in financial assets or assets with that are highly liquid. Clearly, they're a going concern, and they're not about to be liquidated. And if I look at their EPS for 2010, it was $1.77. Their 2011 estimated EPS is $1.99. They don't have negative EPS or highly variable EPS. I don't like approach number one. I'm willing to discount it. That's not appropriate. Number two, price to earnings ratio using the trailing earnings. Well, we said in their history that they closed a bunch of stores and they had a restructuring charge, which might be reflected in earnings. So possibly the forward earnings are a better place to be. And approach number three says price to earnings ratio using normalized earning. This is taking a full cycle and finding the midpoint in the EPS on that full cycle. And in determining the earnings that we can use for each of the EPS, we can easily back out. We can adjust for that non-recurring event. Would that seem appropriate? Well, let's go up and just have a look at the description of YouFixit. It says here, the home improvement industry is cyclical. So it is a cyclical industry. So normalized EPS does make sense. Given that we're only given these three approaches, number one, number two, number three, I would take the approach of number four, which would be a forward earnings multiple, but that's not given. I can get rid of one. I can get rid of two. I will accept three begrudgingly. It's not my. It would not be the selection that I would choose if I were free to choose. But in choosing among the three, I would choose approach number three. So which is the most appropriate, given that we only have 1, 2, and 3? 3 is the most appropriate. Canaan's preference to use the PE ratio over the price to sales ratio is best supported by reason 1, reason 2, reason 3. Remember we went through and we said, well, reason 1 is not true, reason 2 is not true, reason 3 is true. So we can select reason 3 because it is true. We can get rid of 1 and 2 simply because they are not true. There might be better reasons to justify PE than reason 3, but given reason 1, 2, and 3, 1 and 2 simply were not true. 22. The cash flow measure that Ritter would most likely recommend to address Canaan's concerns is free cash flow to equity, earnings plus non-cash charges, remember that was CF, and earnings before interest, tax, depreciation, amortization, that was EBITDA. And which one was most appropriate? As we were going through the description of why he wasn't using cash flow, he had all these reasons why. Cash flow to equity solved all those reasons why. Free cash flow to equity. 23. Based upon the information in Exhibits 1 and 2, Canaan would most likely conclude that Delight shares are over, under, or fairly valued. Based on the information in Exhibits 1 and 2. Well, Exhibit 2 gave us some comparables along with their PE ratio and their growth ratio, their forward PE and their growth ratio. So we, in question 18, had already calculated the forward PE for Delight at 18.71. So we had 18.71. If we divide that by its growth ratio, we have a PEG ratio of 1.5. And all I've done here is I've taken the other four that were in that exhibit. Here's their PE ratios. Here are their growth ratios. Remember, this is the one we were concerned about with a PE of 44, but it has a growth rate of 20%. And if we calculate the PEG ratios, we see that no, it is still fairly high. The lower the PEG ratio, the more undervalued relative to the others. The higher the PEG ratio, the higher the PEG ratio. So we got 1.507. The sector is 1.519. So we can see compared to the sector, it's just slightly under. We can call it the same. It's basically slightly under. If you had to round this up, it would be 1.51. This would be 1.52. Fit is 1.74. This is 1.3, which is below. And then you have, of course, the 2.05. But if the sector average is 1.519, Delight is 1.507, I think we conclude that Delight appears to be fairly valued relative to the sector. We can say that Tasty root beer seems to be relatively overvalued compared to the sector. Fit seems to be slightly overvalued, and N slightly undervalued. The measure of central tendency that Ritter would most likely recommend is we already mentioned it, the harmonic mean. All right, the following information relates to questions 25 to 30, and in this one we're going to take a different approach. In the first one, we read the vignette, then we went to each question, and we found ourselves going back to the data. Here, let's just scroll right down and let's read the questions so that as we read the vignette, we might be able to answer some of them. Based on Exhibit 1, the trailing PE for Centralino as of January 1st, 2015, ignoring any business cycle influences, closest to. So we need a trailing PE. So we're going to look for price and we're going to look for the most current. We're going to look for E0 for Centralino. Based on Exhibit 1 and Rizzo's estimate of return and dividend growth, Centralino's justified forward PE based on the Gordon Growth Dividend Discount Model is closest to. Well, we know how to do that. Based on the price-to-book multiple for Centralino, based on Exhibit 2, the price-to-book multiple for Centralino is closest to, so we still have a price. We're looking for book value. Based on Exhibit 2, the multiple of enterprise value to sales for Centralino as of December 31st, 2014 is closest to. We're going to look for market value of equity, market value of debt. We're going to see if there's any preferred in there, look for any cash or marketable securities. Based on Exhibit 1 and using the harmonic mean of the peer group, forward PE shown in Exhibit 3, as a valuation indicator, the common shares of Centralino are, so we're going to make some kind of judgment, and based on Exhibits 1 and 2, the normalized earnings per share for Centralino as calculated by Rizzo should be closest to, so we're going to calculate some normalized EPS. All right, let's see what we have. Andrea Rizzo is a junior analyst with Aquister Fianco, an independent equity research firm. Rizzo's supervisor asks her to update, as of January 1st, 2015, a quarterly research report for Centralino S.p.A., a telecommunications company headquartered in Italy. On that date, Centralino's common share price is 50, so we got our P, we got our price. And its preferred shares trade at $5.25 per share. Well, we have to calculate an enterprise value. Right away, we're aware that there are preferred shares now. Rizzo gathers information on Centralino. Exhibit 1 presents earnings and dividend data, and Exhibit 2 presents balance sheet data. Net sales were $3.182 billion in 2014. Rizzo estimates a required return of 15% for Centralino and forecasts growth in dividends of 6% into perpetuity. So we have our G, we have our R, we have our sales. Earnings per share, 11, 12, 13, and 14. We have an estimate for 15. Same with dividends per share. We have 4 years of results here, and we have an estimate for 2015. We have a return on equity in each of those years, and we have an estimate for 2015 as well. Okay, what else do we have? We have a balance sheet, cash and cash equivalents. Well, we need to know that for enterprise value, right? There's 102. Accounts receivable, inventory, total current assets, property, plant, and equipment, total assets. What do we have here? Current liabilities, long-term debt, 367. We don't have a market value for long-term debt. We're not told anything yet, but we knew we have debt. There's our preferred shares right there. Okay, there's our total shareholder equity, 1027. Note, the market values of long-term debt is equal to its book value, so we have market value of debt. Shares outstanding are 41.94 million of common shares, and we already know the price. So now we can figure out market value of equity. And 16 million of preferred shares. Well, there's 16 million, and we have a price for preferred shares, 5.25, so we can figure out the market value of preferred. So we know where everything is to calculate the enterprise value of the company. Exhibit 3 presents forward price-to-earnings ratios for Centralino's peer group. Rizzo assumes no difference in fundamentals among the peer group companies. So we have 5 different companies here with forward PEs, 5, 9, 8, 3, 3, 15, and 4, 6. Rizzo also wants to calculate normalized DPS using the average return on equity method. So we do have the return on equity for the past 4 years. And what do we multiply that by? We'll multiply that by book value, right? So the normalized DPS using the average return on equity method. She determines that the 2011 to 14 time period in Exhibit 1 represents a full business cycle for Centralino. All right, let's go to the problems and see what they are. All right, 25. Based on Exhibit 1, the trailing PE for Centralino as of January 1st, 2015, ignoring any business cycle influences, closest to. So your eyes should be looking at Exhibit 1 right now. We're looking for the trailing PE, so we're looking for P E naught. And we were told what P was. We're told P was 50. All we have to do is find out what earnings were in the current period. And you will get 564. You should find 564, and that'll give us 8.86 PE on a trailing basis. 8.86, 8.9. If you round that up, you'll get 8.9. Based on Exhibit 1 and Rizzo's estimates of returns and dividend growth, Centralino's justified forward PE based on the Gordon Growth Dividend Discount Model is closest to. So let's figure out what we need first. We can do this two ways, by the way. You can do a justified PE based on E1 is D1 over E1 R minus G. Or if you don't want to deal with any of this justification, you can come up with an intrinsic value and just use that in the numerator, which is V naught is D naught 1 plus G over R minus G. And just fill in the missing numbers here. The dividend, D naught, was 275. And we were told the growth rate was going to be 6%. We were told the required return was 15%, 0.15 minus 0.06, and we will get 32.33 as an intrinsic value for the stock. Then we would take the 32.33 and divide it by the dividend one period out, and our dividend, our earnings, our E1, our earnings, not our dividend, our earnings one period out. It's P naught over E1. And we're using V naught to stand in for P naught here. And of course, this is going to grow at 1.06, and we will get 5.41. Doing it this way. If you can remember that it's really just the dividend payout ratio over R minus G. What was our dividend in D1? The estimated dividend, if you look in Exhibit 1, under the final column, which is an estimated column, you'll see that dividends are expected to be $2.91. Earnings are expected to be $6. And we divide that by R minus G is 0.15 minus 0.06 is 0.09. You will get 5.39. Basically the same number except for some small rounding errors there. So can we call it 5.4? I think we can. So again, on this one, if you can remember what the formula for the justified PE looks like, just go ahead and substitute in your numbers. And of course, we're looking on a forward basis here, justified forward PE. If you can't, just remember what the Gordon Growth Model is. V naught is the dividend one period out R minus G. Find a value, a justified value, and then divide it by the earnings one period out. And 564 at 1.06 would have given you the same 6. You would have ended up with the same. You end up with the same justified forward PE. 27, based on Exhibit 2, the price to book multiple for Centralino is closest to. So here we're looking at price to book is closest to, and there are two ways we can go about this. You can convert book value in Exhibit 2, which is an aggregate amount, which is a company level amount. You can convert that to a per share amount, or you can simply convert price to the value of equity, to the entire value of equity. So we'll multiply the price by the number of shares and leave book value the same. So what was our price? It was 50. How many shares did we have? 41.94. And if you look in Exhibit 2 for book value, you'll get 947. And if you do the math on that, the calculator worked, 2.214. You would have arrived at the same value if you would have taken $50 divided by 947 divided by 41.94. That's book value per share down here, per share down here. And this was just the full amount of the price of equity divided by the full amount of the book value. You get the same number, 2.214. We'll take 2.2. Based on Exhibit 2, the multiple of enterprise value to sales, EV to S. S I can look up. I see it in the exhibit. Enterprise value I got to figure out, right? It's the market value of equity. I know I have preferred, so I got to deal with the market value of preferred, the market value of debt, and I can take off any cash. So my market value of equity is 50 times 41.94. I figured it out up here. So there's the market value of equity plus what's the market value of preferred in this case? The price was $5.25 and we're told we have 16 million shares. What's the market value of debt? We're told the book value of debt is the market value of debt, 367, and there's 102 sitting on the books. So this will give me 2097, which I already knew. Well, I would have known had I expanded the top out here, but that's 2097 plus, if I do the calculator work here, I get 84 plus 367 minus 102 will give me 2446. There's my enterprise value, so there's my numerator. I know my denominator, I can simply just look it up, so I will get on enterprise value to sales, I'll get 2446 over 3182. 3182 was given to us in the text of the problem, not so much in the exhibit, but in the text of the problem. This is 0.7687, 0.77. We'll round it off to 0.77. 29. Based on Exhibit 1 and using the harmonic mean of the peer group forward PEs shown in Exhibit 3, as a valuation indicator, the common shares of Centralino are. Well, we first of all got to figure out what the harmonic mean is. Remember, we inverted, so it's our N on top. How many companies did we have? We had 5. Over, and it's the inverse of the PEs. It's 1 over, the first PE was 5.9, plus the next PE was 8.3, and the next PE was 3.0, plus 1 over 15, plus 1 over 4.6. So if you do all the calculator work there and then 5 divided by this sum total here, we will get 5.5. And if we look at our company, Centralino, P0 over E1, we had a price of $50. We had expected earnings per share of 6. We have 8.3 on a forward basis because that's what we're looking at here. 8.3 versus 5.5. So the peer group is selling at 5.5 times its forward earnings. Centralino is selling at 8.3 times its forward earnings. Based on just this, we would say Centralino appears to be relatively overvalued. 30. Based on Exhibits 1 and 2, the normalized earnings per share for Centralino as calculated by Rizzo should be closest to. And let's... remember, they were calculating it based on the ROE method as opposed to historical EPS method. So we take our earnings per share for the last 4 years because that was the time period we were told, and we will get not our earnings per share, our ROE 13.01 plus 0.1371 plus 0.1158 plus 0.1421. And we have 4 years. We'll divide that by 4. And we get a normalized ROE, 131. And our book value per share is 947. And we will divide it by the number of shares, 4194. We will get 2258. So there's our book value per share. So all we do is we multiply 2258 by 0.131, which is our ROE. That should give us our earnings per share, normalized earnings per share of 296. Do we have a 296? There we go. So let me just walk through this quickly again just to explain what we've done. We knew that we were going to use the ROE method, ROE times book value, to determine what the earnings per share were. So rather than taking the last 4 years of earnings per share and finding the average, we took ROE, the last 4 years of ROE, and find the average. But to get earnings per share, it's the return on equity times book value. What is book value? That's equity, right? But we need book value per share to do it. So we had to take our book value divided by the number of shares. We get 2258 per share. Once you multiply the two, there's your earnings per share, 296. All right, the following information relates to questions 31 through 37. Let's just go read our questions. Based on Pinho's directive and the data from the last 4 quarters presented in Exhibit 1, the valuation metric that Silveria should use is the, what do we have? PE, PD, production to demand. Never heard of that one. Get rid of it. And EP. So we only have 2 choices for 31. Based on Exhibit 1 and the note to Adhesivo's financial statements, the trailing PE for Adhesivo using underlying EPS is closest to. Okay. Based on Exhibit 1 and 2, which company shares are the most attractively priced based on the 5-year forward PE to growth ratio? So we're going to need a PEG ratio somewhere. Which of Silveria's statements concerning the use of price to sales is correct? Statement 1, 2, both 1 and 2, so there are two statements we'll look at. Which of Silveria's statements concerning the Fed and Yardeni models is correct? 3, 4, or 3 and 4, both, so we have to look at those two. And based on Gesticular's enterprise value to EBITDA, well, based on Exhibit 4, the enterprise value to EBITDA multiple is closest to. And finally, which of Silveria's statements concerning momentum indicators is correct? All right, let's go see what we have now that we're aware of what we're looking for. Katia Pinho, I hope I'm saying these names right. I really do, because I'm not sure if I've got the right pronunciation. But you get it, right? Katia Pinho is supervisor in the Equity Research Division of Sweet Securities. Pinho asks Flavia Silveria, a junior analyst, to complete an analysis of Adhesivo, Enviedo, and Gesticular. Pinho directs Silveria to use a valuation metric that would allow for meaningful ranking of relative value of the three company shares. Exhibit 1 provides selected financial information for the three companies. So we have the current price, we have diluted EPS for the last 4 quarters, and we have diluted EPS for the next 4 quarters. All right, do we see a problem here with the last 4 quarters? We have a negative EPS here, so a trailing EPS probably isn't going to be something we want to use. And in one of the questions, we had a choice between a PE and an EP. The EP seems to be more effective here, so I think we've answered one of our questions. And finally, we have a dividend rate, annualized, and it's the most recent dividend, 44,124, and no dividend over here. Silveria reviews underlying trailing EPS for Adhesivo. Adhesivo has basic trailing EPS of 84 cents. Now, if we look over here and we look at our EPS over here, we have 81 cents. It says here's diluted EPS of 81 cents, and it says here 84. So there's some discrepancy. We have to figure out what's going on. Silveria finds the following note in Adhesivo's financial statements. On a per-share basis, Adhesivo incurred in the last 4 quarters from a lawsuit a non-recurring gain of 0.04, and from factory integration, a non-recurring cost of 0.03, and a recurring cost of 0.01 in increased depreciation. So do we want to keep that 4 in there? Probably not. Do we want to keep that 3 in there? Probably not. So if we take the 81 cents and we take out the 4, we'd get to 77. And if we add back the 3, we would get to 80. Okay, do you see what I did there? We have diluted EPS in the last 4 quarters of 81, but it included this 4-cent non-recurring gain, so we'll take it out to 77. But it included this non-recurring cost of 3, so we'll bring it back up to 80, and we'll ignore the penny here. Silveria notes that Adhesivo is forecasted to pay semi-annual dividends of 24 cents, 0.24 next year. Silveria estimates 5-year earnings growth rates for the 3 companies which are presented in Exhibit 2. So here's our 5-year growth rate, 16, 21, 32. Pinho asks Silveria about the possible use of the price-to-sales ratio in assessing the relative value of the 3 companies. Silveria tells Pinho, here are the 2 statements we have to look at. The price to sales is not affected by revenue recognition practices. That's not true. Statement number 1 is not true. The price to sales is affected. Statement 2, the price to sales is less subject to distortion from expense accounting than is the PE. Yes, because this is price to sales. Has nothing to do with expenses yet. That's top line number. We like statement 1. We don't like statement 2. I think we answered another question. Pinho asks Silveria about using the Fed and Yardeni model to assess the value of the equity market. Silveria states the Fed model concludes that the market is undervalued when the market's current earnings yield is greater than the 10-year Treasury bond. Well, that's not true. The Fed model concludes the market is, that is true, is undervalued. Yes, is undervalued. The market is undervalued. Okay, so number 1 is true. I got confused with under and overvalued. Yes, that's true. Statement 4, the Yardeni model includes the consensus 5-year earnings growth rate forecast for the market index. And that's true. So we like statement 3 and 4. So there's a valuable lesson there. Just thinking that you're reading the word correctly could cause you grief. That says undervalued, not over. I was reading it as over. Silveria also analyzes the 3 companies using the enterprise value to EBITDA multiple. Silveria notes that the EBITDA for Gesticular for the most recent year is $560 million, and gathers other selected information on Gesticular, which is presented in Exhibit 4. Market value of debt, market value of common, market value of preferred, cash, and short-term investments. Well, I mean, really just adding these up and subtracting these two seems rather juvenile. I don't know why they just didn't give us the number, but there it is. Pinho asks Silveria about the use of momentum indicators in assessing the shares of the 3 companies. Silveria states, let's scroll that up a bit, relative strength indicators compare an equity's performance during a period with the performance of some group of equities or its own past performance. That's exactly what it does. Statement 6, in the calculation of standardized unexpected earnings, the magnitude of unexpected earnings is typically scaled by the standard deviation of the analyst's earnings forecasts. Well, that's not true. It's not scaled by the standard deviation of the analyst's earnings forecast. It's scaled by the standard deviation of the past surprises. So in statement number 6, I think we can discount that one. So let's go see if we can solve some of those problems now. 31. Based on Pinho's directive and the data from the last 4 quarters presented in Exhibit 1, the valuation metric that Silveria should use is the, and I said, let's get rid of this one right away because it's meaningless. Whenever we write these questions, well, I say we as professors, we write questions for exams all the time. It's easy to come up with the right answer because that'll be one of them. It's kind of easy to come up with at least one wrong answer that sounds reasonable. Sometimes you can come up with 2 wrong answers that sound reasonable. But when you simply just can't come up with another one that sounds reasonable, throw garbage in, but make it sound good. You know, you put some words in there that make a student stop and go, oh, what is that now? Listen, if you get to an answer where you look at it, production to demand ratio, you think, production to demand, that sounds like something. I don't remember that. Well, if you don't, trust yourself. You don't remember it. It's garbage. It's just something we put in because we can't figure out another answer that wouldn't be so obviously wrong, but would still give you grief. Just get rid of any garbage you find in there. So the PE ratio or the earnings to price ratio. Well, we saw that one of the earnings was negative. We had a negative value for earnings, so a PE would be meaningless at that point. But the earnings, an earnings yield, would still rank them. So we would use C. Based on Exhibit 1 and the note to Adesivo's financial statements, the trailing PE for Adesivo using underlying EPS, underlying. And we already went through that. Remember, it was 0.81. But there was a 4-cent gain from a lawsuit. Let's say we said, let's take that out. But there was a non-recurring cost of 3 cents in there. We said, well, let's put that in. So the underlying EPS is 0.8. So what was the price? If you go back and look, price of $14.72, and we're going to use the 0.80 in this case. We get 18.4. 33, based on Exhibits 1 and 2. Which company shares are most attractively priced based on the 5-year forward PE to growth ratio, the 5-year PEG ratio. So we need the PE of both, the forward PE of both, divided by their growth. So let's just do them in order here. We had 1472 divided by 0.91 for Adesivo, and we'll divide by their growth rate of 16.67, and we get to 0.97. For Enviado, price 72.20, and that was divided by 310. And of course their growth came in at 21.91. We got 1.06, and Gesticular was 132.16, 285, but they had a growth rate of 32.33. That gave them a peg of 143. We want to pay the lowest for something. There we go. Adesivo. Attractively priced. Most attractively priced based on the 5-year PEG growth. The 5-year forward PE to growth ratio. Which of Silveria's statements concerning the use of the price to sales is correct? We said number 1 was not true, but number 2 was true. There we go. Statement number 2 only. 35. Which of Silveria's statements concerning the Fed and Yardeni model is correct? Well, we said 3 was correct after I read it properly, and we said 4 was correct. So both statement 3 and 4 are correct on that count. Based on Exhibit 4, Gesticular's enterprise value to EBITDA multiple is closest to. And we had everything there we needed for enterprise to calculate enterprise value. We just had to do the math. 6766 plus 1733 plus 275 minus 581 minus 495. If you go back and check those numbers, you'll see we're adding market values of debt, equity, and preferred equity, and subtracting all the cash and marketable securities. We get 7698. So our enterprise value to EBITDA, we have our numerator 7698, and we can look up our denominator is 560. And that'll give us 13.7. Do we have a 13.7? We have a 13.7. And finally, number 37, which of Silveria's statements concerning momentum indicators is correct? Statement 5, statement 6, or both 5 and 6? Well, we felt 5 was right. We felt the second one, well, it was wrong. And when it talked about the standard deviation, the denominator was the wrong denominator. So in this case, statement 5 only.